There's so many, I guess, sort of macro stories that are converging at this moment in time. I mean, there's obviously all the drama playing out in D.C., the anticipation around what an incoming Biden administration is going to look like from a policy and market perspective as well. And then on top of all of this, we have the rising rates story playing out, too. I guess what's sort of dictating the narrative? What has you the most concerned?
Well, I would say rates are probably the issue we are focusing most of our attention on. So, Morgan, for the last 29 years, we have had a Goldman Sachs set of conferences across Europe. I always refer to it as a Napoleonic March. We went to London, Paris, Zurich, Frankfurt, Milan. We've always done this in the second week of January. Well, obviously, with the pandemic, this year we had to do it remotely. So we did a virtual set of conferences. We had 5,000 people participate yesterday. We had some interaction, and we did survey a couple of some macro questions that we put there. And Morgan, to your point, one of the first questions was what kind of rate 10-year Treasury yield did the portfolio manager community in Europe expect for the end of this year? And more than half were expecting somewhere between 1 and 1.5%. There was some who expected it to be higher, but the bulk of the portfolio managers expecting 1 to 1.5%. In our view, that would be one of the risks. Our forecast, in fact, anticipates that rates perhaps could go as high as 1.5% by the end of the year. Our biggest concern, way to think about it, is if interest rates were to back up by, say, almost 40 basis points in a month, that's really the tipping point. Above that, you tend to get the equity market go down. Whereas if you have a more modest rates can go higher, but if they go in a more sort of steady rise, that is more consistent with equity market prices going higher.
Yeah.
So that's really, I'd say, the biggest issue from a risk perspective in the market right now.
Yeah, I mean, that's such a key point because I guess from a historical standpoint, I mean, we're still talking about low rates, but it's the velocity at which we're seeing that increase. I wonder, given some of the comments we've heard from Fed officials over the past week plus, the debates that are playing out, I mean, we got that, I guess, in line with expectation CPI number today, but I mean, you look at something like agricultural commodities, for example, those are spiking. Where you fall within this debate more broadly around inflation and the risk to markets?
So my colleagues in economics would anticipate that there's not much inflation. We're not seeing it. There's obviously some idiosyncratic data points at any point in time you could focus on. ISM prices paid, for example, jumped a lot. We don't think that's as reflective of what the underlying trend in inflation is, and therefore the idea of tapering is likely to be a early 2022 event as opposed to later this year. I'd say that's a topic of conversation that comes up a lot with clients. The steepening of the curve is I think, the more interesting dynamic. We're just not seeing a lot of the inflation. Basically, half of inflation is medical costs and housing. Just not seeing that increase. That's in our model would be suggestive of a risk of a lot higher rates. And so, from an equity perspective, we've got earnings that are going up, and there's quite a lot of operating leverage. I think the most important sort of message and discussion point with clients is we are record high levels of operating leverage in the market, highest in 10 years specifically, but it's super high, and that means each incremental dollar of sales is magnified at the EBIT level or the earnings level, and that's, I think, an important point of how we think about attacking or investing in the market in 2021. We're looking for companies with very high degrees of operating leverage. Those stocks, once the Pfizer-BioNTech, the high efficacy rate of that vaccine came forward, these stocks started to rally a lot. They basically just hold even to where they were a year ago. We think there's more upside on that basis. Where do you find companies with high degree of operating leverage? Certainly a lot of industrial companies, some of the more cyclical aspects, and that of the economy, whether that's the consumer, some of the retail, that's an area that's likely to benefit most from an improvement in the economy. We're not seeing the inflation. You got low rates, economic activity on the path to more normalization with the vaccine. That's a core part of our assumption that that's going to get rolled out. I think that's the best strategy at this time.
Shepard Smith here. Thanks for watching CNBC on YouTube.